Now we will start with another topic on depreciation. So under this topic we will be studying the following. One is the concept of depreciation, then the meaning of depreciable assets, and the objectives for providing depreciation, the factors involved in measurement of depreciation, and the various methods of providing depreciation, and then profit or loss on sale or disposal of depreciable assets, then changes in the method of depreciation, and finally revaluation of the depreciable assets. So let us start with the concept of depreciation. So depreciation is defined as diminution in the utility or value of an asset due to natural wear and tear, exhaustion of the subject matter, reflection of time, accident, obsolescence or similar causes. So here the words are important. One, it says it is diminution in the utility or value of an asset. That means as an asset is used or because of other factors, there is decrease in the value or the utility of the asset. That has to be measured and that has to be accounted for. So basically it is decrease or diminution in the utility or value of the asset, and this happens because of so many factors, and these factors are also mentioned in the definition. One, it says to natural wear and tear. It is because of the use the assets undergoes wear and tear. Second is exhaustion of the subject matter. In case of certain assets called depleting assets, the subject matter itself gets exhausted. For example, in the case of mines where ores are being mined. So in that case, as and when the mines are removed from the earth, the subject matter itself gets exhausted. That is called the exhaustion of the subject matter. Normally we call it the depletion of assets. And third is efflection of time. That means the passage of time. So even because of passage of time, there is some diminution in the utility or value of the asset. For example, even if an asset is purchased and kept unused, it will still undergo diminution in its value. So that is called the diminution on account of efflection of time. And accident, because of accident also it may lose its value. And finally obsolescence or similar causes. That means the particular asset may become obsolete, in which case the value will obviously go down much faster. So these are the various factors on account of which any asset loses its value over a period of time. And depreciation can be classified based on the cost. So the depreciation caused by efflection of time, accident, obsolescence, etc. is described as external depreciation, because these are factors which are external to the entity. Therefore it is called external depreciation. So we can define external depreciation as diminution in the value of the asset on account of efflection of time, accident, obsolescence, etc. And the other factors, that is the natural wear and tear, is called an internal depreciation. So internal depreciation is one caused by natural wear and tear. And depreciation, when we talk of depreciation, it normally includes amortization of assets whose useful life is predetermined. In certain cases, certain assets, the life is predetermined. So there we would like to take that value to zero at the end of that useful life. For example, when a goodwill is taken as an asset, it is amortized over a period of 5 years, or whenever there is a preliminary and pre-operative expenses, they are amortized over a period of 5 years. So this is called amortization of assets. So depreciation normally includes not only depreciation but also depletion and amortization. So now we will discuss what is the meaning of depreciable assets. What assets can undergo depreciation? So depreciable assets are defined as those which are expected to be used during more than one accounting period. Normally a depreciable asset is one which can be used for a number of periods, normally at least more than one accounting period. For example, if machinery is bought, normally it will be used over a period of time, so it becomes a depreciable asset. Similarly, furniture is used for a number of accounting periods, so it is a depreciable asset. For example, vehicle is used for a number of years, so it becomes a depreciable asset. And has a limited useful life. So all depreciable assets have a limited useful life. The useful life could be 5 years or could be even 20, 30 years also, but still it is a limited useful life. And third important part of the definition is depreciable assets are those which are held by the enterprise or used in the production or supply of goods and services or rental to others and or for administrative purposes and not for the purpose of sale in the ordinary course of business. That means these are not assets held for the ordinary course of business of sale. For example, an entity which is dealing in sale of cars, whatever cars they are holding is held for the purpose of sale in the ordinary course of business. So, car is not a depreciable asset for an entity dealing in cars. But whereas the same car, if it is held by an entity engaged in some other service, then car becomes an asset held for either production or supply of goods and services or for rental to others. That means it can be even rented to others or for administrative purposes. For example, machinery or furniture or air conditioner used in the office of an entity is for administrative purposes. So, that is also treated as a depreciable assets. So, normally depreciable assets are fixed assets which are used in the entity, which are used by the entity. So, all these characteristics have to be met to be called a depreciable assets. That means depreciation can be provided only in case of depreciable assets. In the case of other assets which we normally call current assets, depreciation is not provided for. If some assets like machinery are held as current assets, then there is no question of providing depreciation for those assets. Therefore, the definition of depreciable assets is very important in accounting. Now, let us try to understand the objectives for providing depreciation, why depreciation needs to be provided for. And first of course is the correct income measurement. As we know, when we studied the different concepts, we studied one concept known as the matching concept. The matching concept states that all the expenses incurred for earning the income during that accounting period have to be accounted for. So, depreciation also is an expenditure because it is the loss of value of an asset for the purpose of use of that asset in the production or rendering of service or for some other purpose. So, in order to ensure that the income measurement is done correctly, we need to take all expenses which are incurred by the entity during that accounting period. So, since depreciation is also an item of expenditure, we need to provide for depreciation in the income statement. That means depreciation has to be taken as an expenditure. Then the true position statement. This is in respect of the balance sheet. Balance sheet gives the position of the assets and liabilities of the entity at the end of a particular period. And if the assets are shown at the historical cost, then it will not represent the true position because those assets have suffered a diminution in their value. So, this needs to be reflected. This can be done by providing for depreciation on the assets, so that the assets are stated at a lesser value than the historical cost of those assets. So, this gives rise to the position that the position of the assets is stated in a correct manner. So, this is the second objective of providing for depreciation. Third is funds for replacement. Normally, since the depreciable assets have a limited useful life, the entity needs to provide for replacement of these assets at the end of the useful life of that particular asset. So, funds have to be earmarked, kept separately. So, this is treated as an expenditure and can be kept separately, provided for. Though normally it may not be kept separately, but at least it is provided for. So, funds for replacement of the assets after the end of their useful life is one of the objectives of providing for depreciation. And the last objective is ascertainment of true cost of production. So, in the case of a manufacturing company or a company rendering services, we need to find out what is the total cost of production, that means or the total cost of service. And the total cost can be ascertained only if we are able to take into account all the expenses incurred in providing the service or in producing that particular product. And since depreciation is an item of expenditure, it needs to be included. So, these are the four important objectives of providing depreciation in the books of accounts of an entity. And now having learnt that depreciation needs to be provided for achieving the objectives, we have to find out as to how to measure depreciation. And for that we have to understand what are the factors which are required to be noted in order to measure depreciation. So the factors in measurement of depreciation are three. One is the cost of the asset, which includes the expenses for installation, commissioning, trial runs, etc. So the cost of the asset has to be ascertained. This is the historical cost at which the asset has been acquired by the entity. Second is the estimated useful life of the asset. So this is a very subjective issue, but it needs to be done on the basis of certain parameters, and then we have to arrive at the useful life of the asset. And third is estimated scrap value, if any, at the end of useful life of the asset. At the end of the useful life of the asset may still fetch some value if sold in the market. That is known as the residual value or the scrap value. This also needs to be estimated in the beginning. So once we know these factors, then we can go to the actual measurement of depreciation. So the factors which are needed for measuring the depreciation are: one is the cost of the asset, that is normally the historical cost. Second is the estimated useful life of the asset, and third is the estimated scrap value, if any. It is not necessary that every asset must have a scrap value, it could be zero also, but wherever it is having scrap value, that has to be estimated and that has to be taken into account in measuring depreciation. So with all the three factors known, we now can calculate the actual amount of depreciation. It is calculated by the following equation: amount of depreciation is equal to depreciable amount divided by the estimated useful life. So here the denominator, that is estimated useful life, is already known, the entity is already estimated, and for that we have to calculate what is the denominator, that is the depreciable amount. That is also defined as the amount of a depreciable asset is its historical cost or other amount substituted for historical cost in the financial statement less the estimated residual value. In simple terms, depreciable amount means it is the historical cost of the asset minus the residual scrap value or the estimated scrap value or the estimated residual value. And the definition also says any other amount substituted for historical cost. What is the meaning of that? It means that whenever assets are revalued, that is the value substituted for the historical cost. For example, if you have taken building at the historical cost of 1 lakh and after 5 years the entity wants to revalue the cost of the building. If it is revalued at 5 lakh, that becomes the substituted cost or the historical cost. Then the depreciable amount will be 5 lakhs minus the estimated residual value or the scrap value. If there is no revaluation of assets done, then it will be the historical cost minus the estimated residual value. So to put it in other way, amount of depreciation is equal to the historical cost minus estimated residual value divided by the estimated useful life of the asset. To illustrate this with an example, let us say there is a furniture which is bought for 1 lakh of rupees. That becomes the depreciable, the historical cost of the asset, and let us say it has got a useful life of only 10 years and it has no scrap value or estimated residual value is 0. So the depreciable amount here will be historical cost minus estimated residual value, that is 1 lakh minus 0, which will be 1 lakh only. So the depreciable amount of this asset is 1 lakh and the estimated useful life is 10 years. So the amount of depreciation will be 1 lakh divided by 10 years, that is 10,000 per annum. That will be the amount of depreciation. That is how depreciation is calculated by using that formula. And now we will come to the different methods of providing for depreciation. As we know, there are a number of methods which are used for calculating or providing for depreciation, and two of the common methods are known as the straight line method, also called the SLM, and the written down value method, also called the WDV method. WDV method is also known as the reducing balance method. As far as income tax is concerned, income tax prescribes only the WDV method of calculating depreciation, except in case of undertaking engaged in generation and distribution of power. That means in terms of Income Tax Act, it is mandatory for entities to follow the WDV method, whereas for the purpose of Companies Act, there is no mandatory requirement of following a particular method of depreciation. Companies are free to choose whatever method of depreciation suits the entity best. But normally, since income tax rules provide for WDV method, most of the entities follow the same method even in their accounting. Now let us try to understand the two different methods which are commonly used and how to calculate the amount of depreciation in case of each of these methods. Let us start with the straight line method, also known as the SLM. So straight line method, an equal amount is written off every year during the useful life of an asset, so as to reduce the cost of the asset to nil or its residual value at the end of its useful life. The idea here is, at the end of the useful life of the asset should get reduced to either 0 if the residual value is 0, or to its residual value if it has got certain residual value. That means the cost minus residual value has to be treated as depreciation during the entire useful life of the asset. Therefore, we calculate the amount of depreciation as cost of asset minus residual value divided by the estimated useful life. So the depreciation rate here becomes depreciation into 100 divided by cost of asset. In the same example which we took earlier, since we are providing depreciation of 10,000 per annum, the depreciation rate will be 10,000 into 100 divided by cost of asset, that is 1 lakh. So this works out to 10%. So under the straight line method, we are providing depreciation at the rate of 10% on the furniture item. So that is how depreciation rate is calculated in the case of a straight line method. Now coming to the written down value method, that is also called the WDV method. Here, instead of taking the same percentage every year based on the historical cost, what we do is a fixed percentage is determined and the same percentage is applied on the asset, but on the reduced value at the end of a particular year. That means, though the rate of depreciation remains the same, the amount of depreciation is higher in the beginning and keeps on reducing as years go by. For example, let us say if you have decided to provide for 10% depreciation, the rate is fixed and the historical cost is 1 lakh. So in the first year it will be 10% of 1 lakh, that is 10,000, and after this 10,000 is taken off from the asset, the written down value of the asset at the end of the first year will be 90,000 rupees. In the second year, we have to provide depreciation of the same percentage, that is 10%, on the reduced balance, that is 90,000. So the amount of depreciation for the second year will be 9,000 rupees instead of 10,000 as it would have been if we had chosen the straight line method. And in the third year, it will be 10% on 81,000, because 81,000 will be the reduced balance at the end of the second year. So it will become 8,100 for the third year and so on. So from this you can see that though the percentage rate of depreciation remains the same, the actual amount of depreciation keeps reducing year after year. It is higher in the beginning and lower towards the end. And here the depreciation rate is calculated by the formula as shown in the board, that is 1 minus nth root of residual value into 100 divided by cost of the asset. So we have to first find out the residual value, like in the other case also we have to find the estimated residual value or the scrap value, and the cost of asset is known, that is the historical cost, and from that you find out the percentage rate, and that rate is applied on the basis of reduced balance method. This is how WDV method operates in accounting. Now we will also talk a little bit about various other methods of providing depreciation. They are as under: one is called the declining balance method, the second is called the double declining balance method, third is called the sum of years of digits method, fourth is the annuity method, then sinking fund method, then you have machine hour method, then you have production units method, then you have depletion method. So as you can see, there are a number of methods of providing depreciation. Normally, what is to be done is the entity has to choose that particular method of depreciation which suits it the best. Based on that, they have to start providing for depreciation. So, we will try to find out what is the meaning of each of these different methods of providing depreciation. First one is the declining balance method. So, in this method, as we know, declining balance means here we would like to reduce the amount of the asset at a faster rate. Therefore, it is called a rapid depreciation method. So, that means we would like to take higher depreciation so that the value of the asset reduces faster. So, here what we do is, first we find the percentage rate to be applied to the residual balance rather than to the original cost. Second, this assumes a constant rate of depreciation per year. That means the rate of depreciation will be constant, but it will be on the reduced balancing method than the original cost. That is how declining balance method is done. So, this is exactly same as the written down value method. That means you keep on applying the same percentage rate to the reduced balance. So, this can be illustrated with the help of an example. Let us say the cost of an asset is 1 lakh, useful life is 5 years. So, first year depreciation will be rupees 20,000, that is 20%. In the second year, it will be 20% of reduced balance, that is 20,000, 20% of 80,000, that is 16,000. In the third year, it will be 20% of reduced balance, that is 20% of 64,000, that will be 12,000, and so on. So, it is exactly like the written down value method. And then we come to the double declining balance method. So, this is a variation of the declining balance method. Here the amount of depreciation is increased. So, what we do is, first we have to calculate the depreciation by the straight line method and then double the value. For example, if you take the same example of an asset of having 1 lakh value and depreciation of 20% by straight line method, then by the straight line method depreciation will be 20,000, but you have to double this value. That means you have to provide 40,000 depreciation in the first year, and in the second year you have to find out that percentage which has been provided in the first year. That means here on 1 lakh you have provided depreciation of 40%. So, in the second year you apply 40% on the reduced balance. So, the reduced balance will be 60,000. After providing for 40,000 depreciation on 1 lakh, the value will be 60,000. On 60,000 you provide 40%, that will be 24,000. And this 24,000 is taken if it is more than the straight line method. In the case of straight line method, we have found out that it is 20,000. Since 24,000 is more than 20,000, for the second year you take it as 24,000. Then the asset value, the depreciable amount goes down by 24,000, that is 60,000 minus 24,000, which comes to 36,000. In the third year, if you apply 40% of 36,000, it will be 14,400, which is less than what is provided in the straight line method. In such a case, in the third year you have to apply the straight line method. That means until the value of depreciation is more than what is to be provided under SL method, you keep applying the double the rate. After that, you keep applying only what is admissible under the straight line method. So, from third year onwards, we will be applying only 20,000 per annum on that. The same thing can be further illustrated with this example. As you have seen, if you can look at the board, you will see that the cost is 1 lakh rupees, useful life is 5 years. First year depreciation as per the straight line method will be rupees 20,000. Double of this will be 40,000. The percentage works out to 40%. In the second year, it will be 40% of reduced balance, that is 40% of 60,000, which comes to 24,000. In the third year, it will be again 40% of reduced balance, that is 40% of 36,000. But here the total comes to 14,400, which is less than the 20,000 which you would have otherwise provided had you adopted the straight line method. So, the depreciation for the third year will be taken as 20,000. Thereafter, it will be 20,000 every year. That means until the time the depreciation is more than the straight line method, you keep applying the double declining balance method. The moment the depreciation amount goes below what is admissible under straight line method, then we switch over to straight line method. So, in this case what we are trying to do is we are trying to depreciate an asset at a much faster rate than is normally permitted. And the next method is called the sum of years of digits method. As the name suggests, this is the sum of years of digits. That means first we estimate the useful life of the asset. Suppose the useful life of the asset is 5 years and the cost is 1 lakh. Then you sum the 5 years digits. That means 1 plus 2 plus 3 plus 4 plus 5 is total. That will give you 15. So, first year depreciation will always be 5 divided by 15 into 1 lakh, that is 33,334. In the second year, instead of 5 by 15, you take 4 by 15 of 1 lakh, that comes to 26,666. And in the third year, it will be 3 by 15 and so on. In the fourth year, it will be 4 by 15 of 1 lakh, and in the fifth year, it will be 5 by 15 of 1 lakh. Suppose the useful life of the asset is 3 years. Then the sum of 3 years digits will be 1 plus 2 plus 3, that is 6. So, in the first year it will be 3 by 6 of the value of the asset, of the cost of the asset. In the second year it will be 2 by 6, and in the third year it will be 1 by 6 of the cost. That is how the sum of years of digits method can be calculated and provided for. Now, we will go to another aspect in the case of depreciable assets, that is what happens when these depreciable assets are sold after their useful life or even before that, whenever the entity wants to replace those assets. So, there could be two situations. There could be a profit on the sale or disposal of these depreciable assets, or it could be a loss. So, in such cases, profit or loss has to be computed using the WDV method. Such profit or loss has to be transferred to the PL account, and depreciation has to be charged for the period it is used during the year. Suppose it is disposed of during the middle of the year, then that means depreciation has to be provided for half of the year, that is 6 months during that year, and thereafter whatever is the value you have to find out, and what is the profit or sale or loss has to be calculated, and that has to be transferred to profit and loss account. And as there are different methods of accounting for depreciation, there may be cases where an entity may want to change its method of depreciation from one method to another method. So, for that they have to follow certain guidelines laid down by the accounting standards, and these accounting standards are mandatory for all the companies. So, the accounting standard says that the depreciation method selected must be applied consistently from period to period. That means, if an entity chooses one particular method of depreciation, it has to be used consistently from period to period. That means, every year it has to use the same method of depreciation. If for some reason they want to change, then they have to follow the instructions given therein. So, what it says is, a change in the method is made only if, that means an entity can change its method of depreciation provided the adoption of the new method is required by law. Suddenly there is a change in the laws of the country, and the laws of the country state that a different method has to be followed. Then of course it is incumbent upon the entity to change the method of depreciation. So, whenever a change is required by law, the entity has to change the method of depreciation, or whenever a new accounting standard comes up and that accounting standards mandates use of another method, then also it is incumbent upon the entity to change the method of accounting. And third is the choice given to the entity, that the entity considers that the change would result in more appropriate preparation and presentation of financial statement. Because of the changed circumstances and scenario, the entity may find that a different method is more appropriate for the entity. In such a case, they have to justify the change in the method of depreciation, and that can be changed. And what they have to do is, if the change has to be done, then they have to calculate the depreciation from the date of asset coming into existence on the basis of the new method. For example, let us say that the entity has been following the WDV method and they would like to change it to the straight line method. So, when the year in which they change to the straight line method, what they have to do is they have to calculate the depreciation as if the straight line method is adopted right from the beginning, and then find out what would have been the amount of depreciation and what is the deficiency or surplus debited or credited to profit and loss account. If less depreciation has been charged, then the extra has to be provided. If more has been already charged, then that to that extent that entry needs to be reversed. And not only that, after all these adjustments are done, it is to be disclosed in the financial statement. The main objective here is the user of the financial statement must know how the depreciation has been provided, why there has been a change in the method of depreciation, and to what extent such a change in the method of depreciation has affected the profit or loss of the entity. This is required to be made known to the users of the financial statements. And as we said, no, when we considering the definition of depreciation, we said no, the depreciable value of the depreciable asset is the historical cost or such other value changed, that is on account of revaluation. So, we will find out what happened in the case of revaluation of depreciable assets. So, depreciation on the revalued amount based on the remaining estimated useful life of the asset. For example, an asset is revalued during the course of the life of the entity. So, in that case what they have to do is, in addition to revaluing the asset, they have to also reassess the remaining estimated useful life of the asset. That means originally they may have estimated the useful life to be 5 years, and later, let us say after 2 years, they have revalued the asset and the useful life may be another 4 years, in which case they have to take into account 4 years as the remaining useful life of the asset, and based on that they have to calculate the amount of depreciation, and whatever upward or downward revision is there, that has to be adjusted in the P&L account. Suppose they need to make more depreciation provision, then that has to be provided for, or if they feel that the provision made already is more, then that can be reversed. That means those adjustments need to be made in the profit and loss account. And thirdly, these changes have to be disclosed in the financial statement, so that the users of the financial statement will come to know that there has been a revaluation of the assets and the depreciation has been recalculated, and that has been incorporated in the financial statements.